Being a good investor is really about a few things. It's about managing behavior. It's about having a systematic approach, controlling what you can control, which is not the market and how it returns. And lastly, it's about your asset allocation and location. What I've found is that most people are their own worst enemies when it comes to their taxes. There are a ton of studies on this. One of my favorite studies was one that was done from 1996 to 2015. The market averaged 8.2% per year over that time, and the average investor got 2.1%. That is 6.1% underperformance per year. That means, the market was actually almost 4x better than what the average investor did. And the reason this happens is because the average person is their own worst enemy. They don't have a good systematic approach. They see, oh man, last year, this part of the market did well. Now I need to go buy that. And then that year happens and it doesn't do as well and something else does well. And then they move to that one. And then they move to the next one. And then they see all these things about how this year there's going to be a market decline. And so then they sell out and they go to cash. And the way that you get around this is you actually have some set system around how you invest. And how to do that is you just stop doing things at random. What most people do is they honestly just don't really understand what investing is. They pick random stocks that they hear about and think that could do well. We saw this in 2020 when people are like, now we're working from home. Peloton is going to be the best thing, and Zoom and Etsy and all of these companies. And if you go look, most of those companies are actually down over 90% from where they were. Just understand as an investor, when you hear about X company is going to do well, or something happened in the world and X company is going to be the next big thing, that is already priced in. So when you are investing, the market is basically pricing in, and it is priced based on future earnings. And so if you think you're ahead of them, just understand there are people who spend hundreds of hours of weeks. There's AI systems and machine learning tools that are all based on knowing this information way, way, way ahead of you. So now you might be asking, how do I become a good investor? You nail down your asset allocation and you focus mostly on your income and your savings rate. This is the biggest piece of advice that I have for everybody. So when you think about your finances, you start off with, I make this much goes to taxes, this much goes to expenses, this is my surplus. The goal is that you have at least 20% of your income available for surplus and you go invest that. And then you go invest it based on your goals. Let's assume that you have goals in the short term. When you have goals in the short term, you should not be investing those dollars. Why? Well, 70% of the time the market is up over 1 year. So it's above a coin flip, but we have no idea. And typically the stock market goes up, it goes up by some, but when it goes down, because we have a bear market, you're going to see 20, 30% declines over 1 year. And so if you have a short-term goal, that risk is not worth the short-term reward it could have. If your goal is 5 to 10 years, that's where maybe you are more like 60-40 stocks to bonds, maybe 80-20 stocks to bonds, and you scale back risk as you get closer. And then when you have 10, 20, 30, 40-year goals, that's when you can really start to scale up your investments to be more 60-40, 80-20, 90-10, or 100-0. Obviously, a lot of that comes down to your risk tolerance. It is very situational, person to person, of how you should invest. At the end of the day, what I found is that the best investment portfolio is the one that you can stick with for the longest period of time. Research might show that 90-10 or 100-0 is going to have the highest long-term returns. But if you go rebalance your portfolio to be 100-0, the market drops 30% and you sell out of that portfolio, that is not going to be the best move for you. You would have been way better off being in an 80-20 portfolio and being able to handle that downturn. It is really hard to actually get that feeling of what a downturn feels like until you experience it. There are these risk tolerance softwares to use. You can do that, but then every time there's a big market downturn, use that as a gut check. See how you felt. And if you were panicking and really, really worried, that means that you are taking too much risk and you need to reduce that risk. If you don't think about it, you don't look at it, then that is a good sign that you can either scale up risk or right where you're at is a good spot to be. Now let's start to think about what the right asset allocation is. And so asset allocation is basically how you spread your dollars across the market. So this can be the mix of US and international. And inside US, you're going to have large cap and you're going to have mid cap and you're going to have small cap and you're going to have real estate. And then international, you're going to have emerging markets. You're going to have developed international. And then inside of both of these, you're going to have value and you're going to have growth. Growth just means companies that typically are going to have lower earnings relative to their price. Value is going to be companies that typically have higher earnings relative to their price. They're a little bit more established. So what you really want to do is kind of get this breakdown of what you want your portfolio to look like. And everybody has a different philosophy. Some people say, well, let's just look at the size of the market. US is, let's say US is 65% of the global stock market. Well, I'm going to have 65% US. Okay. International is 35% of the global stock market. I'm going to own 35% of international. And then inside of that, I'm going to have some of the emerging markets. And inside of some of US, I'm going to have mid cap and I'm going to have small cap. Other people say, I don't really love that. I think I want to have more US. So maybe they're going to move to 80-20, or maybe they're going to move to 90-10. But what matters here is that you pick these percentages and then you stick with it. So you set your portfolio, money comes in, it gets spread to the right places. And then maybe over a year, US grows to be a lot higher. You take some of that either through new dollars and rebalance and add to international, or you rebalance and kind of sell some and move to international. But the goal is that you have this set portfolio allocation. And so when new dollars come in or dividends happen, you know where to go move those dollars to keep you within that desired allocation. It is really easy for people to say they're going to do that. And then all of a sudden, let's say US large cap continues to grow. And now their portfolio ends up being, 90% US when their goal was 75%. Keeping that in motion and growing can be helpful over time. But what ends up happening is then people who thought they had the right allocation for their risk appetite ends up becoming way too risky. And then a market decline happens and they are really, really struggling to handle it. They're worried. They can't sleep at night. And that is really the power of rebalancing, is making sure you keep your portfolio in the exact allocation that you want. One thing that I want to hit on here too is that you do not have to have your entire portfolio in ETFs or index funds. While I do believe most of your portfolio should be, and this should be retirement dollars that you really want to count on, you can still have a mix of individual stocks in here. So maybe you decide, hey, I'm going to be 80% or 90% ETFs. I'm going to be 10 to 20% individual stocks, maybe your company stock, maybe Bitcoin or some other thing that you believe in. What I've found is that people having some part of their portfolio that they believe in and some part that they actually get to choose and be interested in actually helps behavior and helps people stick with their portfolio. So I know a lot of financial advisors are going to tell you absolutely don't do that. I don't necessarily believe that's the case. All I believe is that you need to come up with the right portfolio. And how I think about this is I have a portfolio split across the world. Some people will say, well, why have portfolio or why have allocation international stocks if a lot of these US companies actually operate overseas? I don't really believe in that viewpoint, because if my belief was, hey, I can get international exposure through US, why wouldn't I just want to get international exposure through international when right now they have higher dividend yields, they have way lower prices relative to their earnings? To me, I would rather get that international exposure from international. But in my portfolios, I have exposures to US large cap. And what I found is most people are over allocated to growth because of the Mag 7 is really skewed that way. We add exposure to specifically large cap value as well. Then we have mid cap, then we have small cap, then we have a couple sector funds, then we own international developed, we own international value, we own emerging markets, and personally, we own emerging markets excluding China, just because there's a lot going on there and we don't really believe in allocating to there. Inside of that emerging markets exposure, we have a little bit of added to India. That's how we think about our portfolio. And then what we do is new money comes in, we send it to the right places. Dividends come in, we rebalance them to the right places. And for most of our clients, because they're not retirees, we get to rebalance either through retirement accounts where you don't have tax, or through new dollars that come in, either from contributions or dividends. And so we really get to avoid selling. The only times we really sell are, one, the tax loss harvest. And so let's say that means you're selling, a US large cap fund like VOO. Well, maybe we're selling and moving to VTI for 31 days and moving back, or we stick there if we really like that other fund, or if we need those dollars for something else. But a lot of our clients, high net worth, high income, they typically borrow versus sell to avoid the capital gains hit. A lot of people I work with, they really believe that picking the right investments when they come in is the most important thing. But at the end of the day, because they've won the income game, they don't need to take that risk. So when you invest in individual stocks, what you need to understand is you have such a wide range of outcomes, right? Because if you look back 20 or 30 years, none of those top stocks exist today. So when you pick an individual stock, you have to get the price right today and you have to get the selling right today versus when you buy a market, right? The goal is that you think, US is going to be better off 20 years. For this high net worth person, let's say you're investing $20,000 a year and, let's say a lower net worth person is investing $20,000 a year and they get a 15% return for 30 years. That means they would have $8.7 million. That's not an easy thing to hit. But then you have this high net worth person who's investing $150K a year. At 7% rate of return for 30 years, they get $14.17 million. So most of the clients I'm working with, they make $1 million or above. They're investing $150K, $200K, $300K. Some of my clients are investing millions of dollars a year. When you can invest in ETFs and index funds, you have a more narrow range of outcomes. Sure, it can still decline. Sure, we could still see a 2000 to 2010, but that's why we have small cap, international, emerging markets, large cap, mid cap exposure, is so that way in certain areas of the market do terrible, we have added exposures to other places that do well. But at the end of the day, when you have this large amount of dollars you can invest per year, you don't need to chase as high of a return because of all those contributions. So you can scale back risk, focus on index funds and ETFs, knowing that you are winning the game by contributing so much. Point being here really is that you just don't need to try and beat the market and chase above average returns. You can focus in on taking what the market has to offer. A lot of people use target date funds. Target date funds are great for the right person or maybe good for the right person. They're terrible for the wrong person. So if you don't really know anything about investing, anything about asset allocation, putting your money in a target date fund is fine. A target date fund is saying, hey, I plan to retire at 2050. And they basically say, great, you're going to be 80% stocks, 20% bonds, this allocation international, this allocation to US. They pick that for you and it becomes way more conservative over time. When instead you could pick your large cap, mid cap, small cap, international, emerging markets exposure on your own. For people who know what they're doing, you typically want to go through and pick your own funds because what ends up happening is, let's say you pick 2050 and you are, about to retire at 2050 at, let's say, 50 years old, and you're not going to touch this 401k money for 20 years, you don't want to be 50% bonds or 40% bonds in that portfolio, most likely. You would typically say that's still long-term money. I want that to continue to grow. Really what I want you to understand is that investing is about having a system and it's about picking the right asset allocation, mapping out what your dollars are used for. So if they're short term, you invest differently than for the long term. You match that asset allocation, you stick with that allocation and you rebalance over a period of time. And that's how you can become a true investor versus just randomly picking stocks. I see all the time people will be like, oh yeah, here's my portfolio, QQQ, VOO, VTI. Those three funds are 98% the same. You are not diversified just because you pick different funds with the same exposures. What actually diversifying means is you own US large cap and then mid cap and then small cap and then international and emerging markets. And I know I've harped on this a lot, but I have never met any individual person who manages their own investments who has any idea on picking their asset allocation right. And it is the most important part of investing. Research shows that 80 to 90% of your returns are dictated by the asset allocation that you have chosen. So go nail yours down today. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.